Okay, I had a few questions regarding the sale of differential assets when accumulated depreciation is involved. And I responded to those emails, but I thought it might be handy to go ahead and put up another example of this just to sort of make sure we've all got this down. This is going to be important because we're going to be doing something sort of related when we have intercompany sales of assets when those assets are subsequently resold to some third party. It's going to be much the same idea. So let's go ahead and make up a quick example. And let's say that we do our S entry for a given year. And we've got common stock, 100,000, retained earnings, 300,000. And let's say we've got some differential asset items. Let's say we've got some land that was undervalued by 30,000. We've got a patent that was undervalued by 50,000. And we've got some property, plant, and equipment where we've got an initial differential of 100,000, of which, let's say, $20,000 has already been depreciated over the previous years. So here's our, oops, and let's have some goodwill also, just for good measure, because there's always going to be some goodwill in these things. And goodwill, let's say 50,000. Okay, again, these are all just random numbers that I pulled out of my sleep-deprived head. Okay, let's say this is an 80% owned subsidiary. And so basically, the investment in little is going to be 80% of all this stuff. So plus 0.8 times the quantity, that plus that plus that plus that plus that plus that minus that. And the non-controlling interest gets the other 20%, or 1/4 of that. Again, 80, 20, 4-to-1 ratio. Okay, and let's say that there was accumulated depreciation at acquisition. Again, just pulling a number out of thin air of $90,000. Okay, a little more things to line, a few more ducks to line up. Let's say that this patent is being amortized at the rate of $10,000 per year. And let's say that the property, plant, equipment is being amortized at the rate of, oh geez, 20,000 or 12,000 per year. Now I realize that we've got accumulated depreciation of 20, which is not a multiple of 12. Let's just assume this was a mid-year acquisition, so we've got a partial year's depreciation in there. In any event, let's assume that that property, plant, equipment was sold by little to some unrelated third party on 8/1 of whatever year this is. Okay, so what do we need to do? So we have this differential asset that's being sold. So we do our amortization. And, just as would be the case if, we were selling an asset that we owned, first thing we do is bring our depreciation up to date. We've had this asset in use for January through the end of July, 7 months. And so we needed to take 7 months worth of amortization or depreciation on that property, plant, equipment. So $12,000 a year for 7/12 of a year, $7,000. Okay. Now, and again, we'd also do the, amortize the patent. Okay. Now, when it comes time to sell this asset, again, we're selling the property, plant, equipment. Little no longer has this property, plant, and equipment. Their property, plant, and equipment balance has a 0 balance. Let's assume this is all they ever had. And their accumulated depreciation has a 0 balance. But what we've done with our elimination entries is we've created some property, plant, and equipment. We've recorded some accumulated depreciation. So we've been putting all this stuff on the consolidated balance sheet. This stuff doesn't exist anymore. We need to go ahead and remove it. So let's go ahead and see what we've got in the way of property, plant, equipment, and accumulated depreciation. Property, plant, equipment, there's a $100,000 debit, a $90,000 credit. So we've got a $10,000 net debit to property, plant, equipment, and that has to be eliminated. By the same token, for accumulated depreciation, we've got a $20,000 credit, a $90,000 debit, and a $7,000 credit. So 90,000 minus 27 is 63,000. So we've got a $63,000 net debit to accumulated depreciation. These things have to be gotten rid of, so we're going to go ahead and credit property, plant, equipment, and we're going to credit accumulated depreciation. All we're doing is we're getting, from the balance sheet perspective, all we're doing is we're getting rid of these asset accounts that we created because the asset no longer exists. On the debit side, this is going to be treated as an adjustment to the loss or gain on sale of the asset. Now, if you think about it, so basically that's a plug figure. If you think about it, up here we had an $80,000 differential being carried forward for property, plant, equipment being carried forward to this year. There was an initial differential of $100,000 when we acquired this company. $20,000 of that has already been written off. So as of the beginning of the year, there's still $80,000 that has not yet been written off. Now, if we hadn't sold this asset, we would write off that $80,000 at $12,000 per year over the next 6 or 7 years. Instead, we wrote off a little bit of it, but the remainder of that $80,000 differential is not going to be written off to depreciation expense. It's going to be written off in a lump sum as an adjustment to the gain or loss on sale of the asset. To reinforce this thing a little bit more, let's say that Little's book value of the asset was, again, pulling a number out of thin air, $200,000. The consolidated book value, again, what did we do? We had an $80,000 differential, so we would have written it up by $80,000. So $200,000 plus $80,000, but then we wrote off $7,000 of it. So from our consolidated point of view, this asset had a consolidated book value of $280 minus 7, $273,000. And let's say it was sold, Little sold it for $300,000. Now, Little's going to report a gain. Again, they sold it for $300,000. It's got a book value to them of $200,000, so they're going to report a $100,000 gain. The true consolidated gain, again, the consolidated book value is $273. So the true gain, $300,000 minus $273, is only $27,000. This, the difference between these two, $73,000. That $73,000 difference is what we're adjusting with this debit to loss on sale. And again, in this example, Little is reporting a gain of $100,000. From our perspective, the true gain is only $27,000. So rather than recording this as a debit to the loss on sale, we should actually be recording it as a debit to the gain on sale, reducing the gain from $100,000 down to $27,000. In fact, on the weekly assignment that you just submitted last night, I showed I said that Little sold the asset at a loss of X dollars, and that's your sort of cue on this, because this entry, you don't know, am I reducing a gain or am I adding to a loss? Now, in both cases, it's a debit to the income statement, but if Little is already reporting a loss on sale, then we're adding to the loss, so that would be a debit to loss on sale. If they'd reported a gain, then we'd be taking away some of the gain. We'd be debiting gain on sale. Again, the main point is we've got these various differential assets. Land has $30,000 of additional value. The patent has $50,000 of additional value. The property, plant, equipment had $80,000 of additional value. If these things are sold, then that additional value needs to be written off, and it's written off as an adjustment to the gain or loss on sale.